We continue to highlight big calls on Wall Street here on the morning show, and there is a new one we want to spotlight. Investors should prepare for a longer run regime shift in markets as the low rate environment transitions to a new world order. It's a good word of our next guest. Tony DeSpirito is BlackRock's CIO of U.S. Fundamental Equities and the Portfolio Manager of the BlackRock Equity Dividend Fund. Tony, great to get some time with you here today. So walk us through this regime shift. What does it mean to investors?
Sure. I think it's a really big deal, first of all. And let me describe what I mean by the regime shift. Post the global financial crisis, we were clearly in a very unique regime relative to anything we had seen in history. Consumers were really licking their wounds. They were unemployed. Their balance sheet was in grave need of repair. Their homes were underwater. They had lost money in the equity markets. And same with companies, as well as banks, importantly. And so what we saw was a period of very low growth and very low inflation by any historical standard. And I think that really came to an end with the pandemic. And so during the pandemic, we obviously shifted to a new regime that was obviously characterized by stay-at-home, tech becoming very much more important, also incredible stimulus, more stimulus than we've ever seen when you think about monetary and fiscal policy combined. And now we're in a new period, a new regime, I'll call it the post-pandemic regime, where actually consumers are in great shape in terms of their balance sheets. Their home prices are up 20%, stock market's up, unemployment's at 3.6%. So the economy is in really strong shape. And instead, the problem isn't low growth, but rather higher inflation. And so we are entering a new world of higher inflation. Now, I don't think we're going to stay at these high inflation numbers that we're at today. It's going to moderate, but we're still going to end up at a higher point of inflation than we saw over the last 12 or 13 years post the global financial crisis.
You make a great point in your note that you sent us, Tony, that it is getting complicated to be an investor. And I hear you on that. Look, we had the CPI print this morning, 8.5% on the headline, and stocks are rallying off of that type of print. It's not what you would have thought at first. So then how do you position your portfolio for this next decade?
Yeah. And so when I think complicated, I actually think that's good. That's good for fundamental investors who are seeking an edge. And we're seeing that today in higher dispersion of stock returns. They're definitely elevated. And so I think you got to really focus on a couple of key issues. One, costs are inflating. So which companies are most impacted by that and which ones aren't? Highly automated companies, for example, are not going to be as impacted by cost increases as ones that are very service and people intensive. So that's one. But then there's a second order question, which is, okay, given the impact of cost inflation, does this company have pricing power? How strong is its ability to raise price? Are there some moats? Is it a unique product, et cetera, et cetera? So that's an important investment question. And then the third order question is what's priced into the stock already? Is there hidden upside or hidden downside? And this is just fertile ground for individual stock pickers.
Where does tech fit into a portfolio now with this new regime, especially given how much they ran up during the pandemic through last year and given the sell-off in many of these names that we've seen this year?
Yeah, so I think it's a fascinating area. It's certainly a big area, an important area of the economy. There are definitely some stocks that I would call COVID hangover stocks that were their prospects were dramatically accelerated by what we saw in COVID, but they're now coming back to normal, right? So there's a group of companies that look like that. But there's also a group of companies, when you think about labor costs and wages inflating, tech is effectively, in many cases, a labor-saving device, all right? It's a productivity tool. And so there are a lot of tech companies that are going to experience actually increased investment in technology because of higher wages, higher inflation. And so I think you're really seeing a bifurcation of names.
Tony, every day we seem to be just talking about the rise in yields, rise in interest rates that are likely coming, 7 to 8 hikes this year, perhaps, who knows? But do you suspect there will be some form of day of reckoning for markets at some point? Could be later this spring, could be this summer. At some point, you would have to think the markets adjust for this land of higher rates.
Yeah, so one of the interesting things is the market never fully priced in super low rates. Now, how do I say that? We run a model where we compare the earnings yield on stocks, so think of an inverted PE ratio, and compare that to the yield on bonds. And what we saw was when bond yields went really low, the equity yields, the earnings yield didn't follow them, right? Meaning the equity risk premium rose. And so based on our models, stocks have been very attractive throughout this period of time. And rates would actually have to go as high as 3 to 3.5% before you'd start to say, okay, bonds and stocks are equally as good, right? So there's still a lot of room for rates to rise from here before I'm worried about stock market valuations.
And when you think about the macroeconomic backdrop and what we're going to be seeing over the longer term, of course, heading into the pandemic, we had inflation sub 2% for years. Given the hot inflation print that we saw this morning, where do you see inflation ultimately leveling out here? And how does that factor into how you're thinking about this new regime as well?
Yeah, look, there are plenty of things about the current environment that are just abnormally high. I mean, I'll call it used car prices, which are actually starting to finally roll over. They were up 40% year over year. That's not normal. And in fact, used car prices are going to start to be a negative driver of inflation, actually, because once the supply of cars catches up to demand, you'll actually start to see used car prices coming down, for example. So I think it's important not to look at the headline, look at core, but then within core to look at more sticky measures. And so we look at the Atlanta Fed measure of sticky CPI. That's more in the around 4%. And so what we see is inflation coming down to that 3 to 4% range between the Fed actions and the fact that just sticky CPI isn't nearly as high as what you're seeing in the headline. And of course, inflation in general is just good for stocks. I mean, that's the history. Equities have done very well during inflation. They've done well even when the Fed is raising rates. That's the chart that you're showing now. And so I do think equities continue to be the best place to be when it comes to inflation and rates that we're seeing.
Is recession talk, Tony, anywhere? Are you talking about this amongst your teams? Are you positioning for it at all, or we're just overblowing it?
Yeah, so I think it's important to be talking about it and to be thinking about it. I think it's way too premature. Even if you look at the inversion that happened last week, it was short-lived. And even then, inversions don't spell recessions for usually, stocks continue to go up for another 24 months. So I do think it's early, but it's not too early to be building greater resiliency in your portfolios, right? So don't panic. A recession's not imminent, but do think about building more resilience in your portfolio. And the ways you do that is to up the quality, to buy companies with healthy balance sheets, strong free cash flow, good businesses with good moats around them. And then when we think about a portfolio, we always think in terms of a barbell. Cyclicals on one hand, non-cyclicals, more stable stocks on the other hand. We have over the last, since the pandemic, really tilted towards the more cyclical stocks. Today, we're moving that tilt more towards the stability stocks, particularly healthcare, because a lot of the stable stocks are already priced up. I mean, utilities, very expensive. REITs, very expensive. Whereas healthcare, it's stable, but it's also attractively priced. And so that's been, in my fund I run, that's been my favorite go-to stability sector.
Good words of wisdom. We'll leave it there. Tony DeSpirito, BlackRock CIO of U.S. Fundamental Equities and the portfolio manager of the BlackRock Equity Dividend Fund. Thanks so much, Tony. We'll talk to you soon.